Welcome to CK Asset Holdings interim results for 2024. My name is Gerald Ma. I'm going to go through the results presentation, which will take about 15 minutes, hopefully less than that, and then I'll open the floor for questions with our management team afterwards. On my right, our chairman, Mr. Victor Lee, and followed by Mr. Edmund Ip, our deputy chairman, and our executive committee member, Mr. Simon Mann. We are all with you today and happy to be showing you our results. Let's go to the presentation, shall we? First half 2024, revenue 34.7 billion, down 4.9%. Profit before IP revaluation 6.7 billion, or $1.91, down 9.1% on a per share basis. IP revaluation 1.8 billion, giving us a profit to shareholders 8.6 billion, or $2.44, down 15.3% on a per share basis. We're happy to declare an interim dividend of 39 cents, down 9.3%, in line with our profit before revaluation. Net book value up 1.4% to $110.23. Principal activities analysis. 87% of our revenue and 82% of our profit contribution is now recurrent in nature, giving us a very strong foundation to move forward. In terms of geographical spread, 39% of contribution from Hong Kong, 8% from the mainland, and 53% from overseas. Turning to divisional performances. We recorded fewer sales recognition in the first half, leading to a lower contribution. Revenue 4.6 billion, profit contribution 1.8 billion, overall margin a solid 39.3%. Major contribution coming from Laguna, Verona, Dongguan, 457 million, LYOS from Hong Shui Kiu, 439 million, 90 Repulse Bay giving us 327 million, Upper West Shanghai giving us 212 million. So, we recorded solid margins across all markets, 40.1 from Hong Kong, 40.3 from the mainland, and 24.5 from overseas. We still have 28.4 billion of contracted sales, which we have not yet recognized. That is up from 19.4 billion at the end of last year, mainly due to the successful launch of Blue Coast. 5.4 billion of the 28 billion will be recognized or scheduled for recognition in 2024 financial year. Property rental, 3.1 billion of revenue, up 9%. Profit contribution 2.4 billion, up 6%, and a very healthy 78.4% margin. Contribution from our social infrastructure from the UK, 648 million. Cheung Kong Centre, 512 million. Hutchison Logistics Centre, 327 million. And the Whampoa, 325 million. If you look at the different sector, contribution from different sector, from a revenue perspective, retail 971, down 7.6%, office 890, down 7.7%, industrial holding firm at 385 million, social infrastructure up 171% to 648 million, giving us a total of 3.1 billion of revenue contribution. If you look at profit contribution, 1.8 billion from Hong Kong and 139 from the mainland and 489 giving us 2.4 billion of contribution altogether. We have 22.2 million of investment properties in our portfolio and recorded in the first half a fair value increase of 1.4 billion before tax and non-controlling interest. This is a result of the net increase we have in Hong Kong, mainly from Hutchison Logistics Centre, and a revaluation deficits from a number of mainland property assets. The after tax and after non-controlling interest valuation came to 1.8 billion in the box of the bottom of the box in the middle. Hotels and service suites, we had a solid recovery in both margin and contribution this year. 823 million of profit contribution, up 29%, and margin recovery from 32.7 last year to 38.6 this year. Average occupancy for our daily hotels, 81%, and 88% for our service suites. And to no surprise, Hong Kong is recorded the majority of our contribution, 853 million. Property and project management, we have 264 million square feet under management and a very steady profit contribution of 180 and a very good margin of 40.4%. Our pub operation, again, we have about 2,600 pubs across the UK. The sector is still affected by the high cost pressure and also the slow recovery in terms of volume recovery, and recorded a 5% increase in revenue in the first half and a 2% increase of profit contribution to 597 million. Infrastructure and utility asset division, these are our JVs and the respective percentages. Just to highlight that CK William, which is our Australian joint venture company, also acquired Phoenix Energy in the first half of this year, a Northern Ireland gas network, for £312 million. UK Power Network also acquired UU Solar, a owner-operator of renewable generation assets in the UK in the first half as well, for £88 million. 2024 first half revenue came to 12.6 billion, and contribution came to almost 4.1 billion with a 32.6% margin. You see that Dutch Enviro Energy, which is essentially AVR, had a negative contribution due to a fire incident for one of our facilities last year. I'll turn the rest of the floor to Simon to finish the rest of the presentation. Simon?
Thank you, Gerald. As of 30th of June 2024, the group's interest in real estate investment trusts remain more or less the same. 34.5% in Wishand REIT, which own and manage a portfolio of 11.8 million square feet of hotels and service suites, office and retail properties on the mainland. A 26% in Fortune REIT, which own and manage a portfolio of 3 million square feet of retail properties in Hong Kong and Singapore. A 18% interest in the Prosperity REIT, which own and manage a portfolio of 1.3 million square feet of office, retail, and industrial properties in Hong Kong. Wishand REIT is an associate, and we share a net loss of 4 million Hong Kong dollars for the period, taking into account its net rental of 56 million and exchange loss of 60 million upon realized upon bank loan repayment during the period. Distribution received from Fortune REIT and Prosperity REIT amounted to 113 million and were recognized as investment income. Together with the 3 million distribution from Wis and Reed, a total distribution of 116 million was received by the group during the period. For the gearing and maturity profile, as of 30th of June 2024, the group's bank and other loan amounted to Hong Kong dollar 56.1 billion. 14.9 billion repayable within 1 year, 34.9 billion within 2 to 5 years, and 6.3 billion beyond 5 years. Taking into account bank balance and deposit of 32.8 billion on hand as of 30th of June 2024, the group carried a net debt of 23.3 billion. The net debt to net total capital ratio was 5.5%, and the net debt to shareholders fund ratio was 6%. We received credit rating from Moody's A2 stable, and credit rating from Standard & Poor's A stable. As of 30th of June 2024, the group had a total land bank of 132 million square feet. 74 million square feet was under development. 22 million square feet was held for rental. 9 million square feet was for hotel and service suite operation, and 27 million square feet was for pub operation. For geographic location, 28 million square feet was in Hong Kong, and 69 million square feet was on the mainland, and 35 million square feet overseas, mainly in the United Kingdom. Pass it back to you, Gerald, for Q&A section.
Thanks very much, Simon. That was short and sweet, I hope. And now we will open the floor for questions. I can see many of you have joined us online today, and questions have begun flooding in. I will go through each of them and consolidate the questions that you may have. Please keep them coming. Again, thank you to our chairman, our deputy chairman for joining us. I'll go to the first questions. CKA's profit before revaluation on a per share basis dropped 9.5%, largely because of the 48% drop in development contribution. Can you give us your overall thoughts on your results?
I think a drop in development earnings is not a surprise to anyone, given we underinvested in land sites in the past. We're pleased to be able to maintain a very strong balance sheet during uncertain times, with gearing only at 5.5%. Our investment into UK social housing has also strengthened the resilience of the investment property portfolio, helping us to more than offset the challenges we're currently experiencing in the Hong Kong market. Together with the strong performance of our infrastructure businesses, our recurring income continues to be solid. Hotel and service suites earnings continue to improve over last year. However, the UK pub sector is still facing a few challenges due to the high cost environment. With continued geopolitical and economical uncertainties under a backdrop of still a higher interest rate environment, I would say this is a respectable set of results. We will continue to embrace our diversified and global approach to seek out investment opportunities with double-digit returns and high social structural liquidity to further strengthen the quality of our balance sheet and the quality of our earnings, while continuing to focus on returns and being financially prudent.
Thank you, Chairman. The next question from our online audience. You dropped your dividend in the first half. What should investors expect in terms of dividend payout for the full year? Are you going to drop your dividend again or do more share buybacks?
We'll decide on our final dividend payout in due course when we have better visibility of our operating results for the whole year. But it is appropriate for the dividend payout to be correlated to our financial results. As I've said in the past, you can deliver long-term value to shareholders by way of dividends or share buyback, especially when our stock is trading at a discount. We've been quite active in the last few months and have so far spent 1.538 billion, buying back close to 49 million shares in the first half. Adding this to the 1.97 billion we spent in 2023, we should have spent a total of 3.5 billion in buyback in the last 18 months and bought back over 94.5 million shares. That's our way of returning value to shareholders.
Thank you, Chairman. The next question is on the Hong Kong residential property market. What is your view on the residential market? The launch of Blue Coast received very strong responses. Will you continue to adopt a similarly aggressive approach for the upcoming launch of Blue Coast Phase 3C and also your Kai Tak project?
Maybe I answer the second half of the question first and go back to the first half. On launching projects, we've always adopted a more market-focused approach when it comes to launching new projects. So I trust Justin and his sales team will come up with the right market-friendly tactics that will be the best for the projects. As to the market in general, I don't have a crystal ball, but what I can say is Hong Kong has been through many cycles in the past decades. And each time the person who makes the most money is the person who buys when everyone else is bearish. My experience tells me that when Hong Kong market turns around, it can turn around very rapidly. History has shown that when this happens, there is not much time for reaction. I'm not going to bet against Hong Kong's ability to recover. Everyone who has done that in the past has been proven wrong. 我唔感到香港嘅市場太差嘅。過去歷史話俾我哋知，邊個到香港長期差都錯嘅。Thank you.
Thanks, Chairman. Next question is for our infrastructure and utility division. This division has been performing really well, and you have made a few more investments recently. Is this the direction, and are you going to invest even more in this sector?
Indeed, this division has been the most resilient in the past few years and has served the company well. Subject to returns meeting our requirement, we are always interested in doing more. While we continue to search for attractive opportunities globally, but also with a keen eye on property and for projects locally, we're pleased to be able to enjoy double-digit IRRs in many of our overseas infrastructure businesses that have good structural liquidity. What that means is that if a great opportunity comes our way in Hong Kong, we have the ability to raise capital internationally for deployment in Hong Kong. 如果香港有好嘅投資機會，我哋會好容易用我哋嘅國際資產嚟籌集資金返嚟香港。Thank you.
Thank you. The next question. Given how property transaction and prices have been trending, what kind of development margins should we expect going forward? Are you still interested in bidding for more projects in Hong Kong?
Easy answer, yes. Margin is a function of market conditions. When the market is weaker, margins can be lower, but when the market starts to recover, margin can expand quickly and more quickly than one can react. Of course, we have interest to bid for new projects in Hong Kong. The key is profit margin and the cost of entry. But then again, we do not have a must-win mentality. We are in an advantageous position now with choices. Currently, we have a number of investments overseas, generating double-digit returns. And when opportunities present themselves in Hong Kong, and should the need arise, we can generate substantial liquidity from these assets to take on very large projects in Hong Kong or the mainland. This is CK. Thank you.
Thank you, Chairman. Another question from our audience. Your property rental contribution went up in the first half, but the Hong Kong office market continues to be weak. Against this backdrop, what is your outlook for the Hong Kong rental division and the office segment in particular? And could you give us an update on CKC2?
Our investment in UK social housing in the last few years has helped us to mitigate the weakness in the Hong Kong rental market. As a result, the overall profit contribution for the division in the first half was quite resilient. The overall occupancy of our Hong Kong investment property portfolio is about 85%, and we will continue to try our best to do better. As for CKC2, it is a great building in an iconic location. It should do great when the market begins to recover. Thank you.
The next question is on revaluation. Are you worried about the negative revaluation pressure for your investment property portfolio?
We actually recorded a revaluation surplus of Hong Kong about 1.88 billion in the first half, which is a net result of recording a revaluation surplus for the Hutchison Logistics Centre in Hong Kong and deficits for certain properties on the mainland. I think this result is because we've always taken a more conservative approach than maybe our neighbors, so I think we'll be fine.
Next question. Any comments on the performance of your hotel and service suite division?
The hotel and service suite division contributed 823 million, a solid 29% increase in contribution to the group in first half 24. The government and private event organizers have been working very hard to bring visitors to Hong Kong. I'm hopeful the overall occupancy of the hotel and service suite division should remain quite steady.
Thank you for all your questions. The next one is, what is your outlook for the pub business for the rest of the year?
In terms of outlook, volume recovery is still a challenge due to the high cost of living and high interest rate environment. And we have been protecting our margins mainly through price increases. Maybe Gerald, you are better positioned to answer that.
Well, I think that the team is tasked to find ways to improve the overall profitability and going forward, while at the same time offer customers a great experience. It's a tough challenge, but we're not shying away from it. We hope the cut in interest rates in the UK will start to improve the level of income, disposable income for all consumers, which should help our business. The next question is on our gearing. CKA's gearing remains very low at 5.5% net debt to net total capital. How much will you set aside for new investments?
Our gearing is low enough that we do not have to set a cap on new deals. In addition to our low gearing, we also have investments that are structurally quite liquid outside Hong Kong. I've been using this term quite liberally today, structurally quite liquid. We are patient, and there's never a must-win deal. The focus is on the margin available and the cost of entry. Simply said, because of our investments overseas, we have the ability to deploy capital from overseas to Hong Kong or the mainland for mega projects when the opportunity arises. 簡單嚟講，因為我哋有國際資產，所以當香港或者內地有比較龐大嘅投資機會嘅時候，我哋可以有能力 隨時動用大量嘅資金翻嚟進行投資。
Thank you, Chairman. I believe most of the questions have been answered. We can close our analyst presentation and conference for today. Thank you for joining us, and we'll see you soon. Thank you.
Thank you.